Hi friends, today we are discussing the weighted average cost of capital. Please watch video on cost of capital for a basic understanding of how to find out the cost of capital of individual components of capital. The components of capitals are debenture or long-term loans, preference share capital, equity share capital, and reserves and surplus. Now we will do some small problems on the individual components of capital to recollect the formula we studied earlier and for a better understanding of the theories. Then we will move on to the weighted average cost of capital. A question on cost of debenture. A company issues 25,000 14% debentures of rupees 1000 each. The debentures are redeemable after 5 years. Income tax 35%. Calculate the cost of debt after tax if the debentures are issued at 5% discount with the 2% flotation cost. Formula for cost of debenture KD is equal to I into 1 minus T plus RV minus NP divided by N, the whole divided by RP plus NP by 2, where I is the interest in rupees and not in percentage, T is the tax rate, RV is a redeemable value, NP is the net proceeds, N is the number of years for redemption. Net proceeds or the amount received in hand is only 930 as there is a 5% discount and 2% flotation cost. Total 7% is to be reduced from the face value of 1000. And the redeemable value we will take it as 1000 or the face value because there is no information about that. By substituting the figures in the formula we will get 140 into 1 minus 35% plus 1000 minus 930 divided by 5 all divided by 1000 plus 930 by 2. By solving, 91 plus 14 divided by 965 is equal to 0.1088 or 10.88 percentage. A company issued 40,000 12% redeemable preference shares of rupees 100 each at a premium of rupees 5 each redeemable after 10 years at a premium of rupees 10 each. The flotation cost of each share is rupees 2. You are required to calculate the cost of preference share capital. Formula for finding the cost of preference share capital KP is equal to PD plus RV minus NP divided by N, the all divided by RV plus NP divided by 2, where PD is the preference dividend and RV is the redeemable value and NP is the net proceeds. For the calculation purpose, we need to consider only one preference share, no need to take the total preference shares. Preference dividend 100 into 12%, that is 12. Redeemable value 100 plus 10 premium, that is 110. Net proceeds 100 plus 5 premium minus 2 flotation cost is equal to 103. Substituting these values, 12 plus 110 minus 103 divided by 10, the whole divided by 110 plus 103 divided by 2. 12 plus 0.7 divided by 106.5 is equal to 0.1192 or 11.92 percentage. Now we will try a small problem on the cost of equity share capital. Piyush Associates presently pay a dividend of rupees 1 per share and has the share price of rupees 20. If this dividend were expected to grow at a rate of 12% per annum forever, what is the firm's expected or required return on equity using a dividend discount model approach? Cost of equity is equal to D1 by P0 plus G. Where P0 is given or the market value is given as 20, G is the growth rate which is 12%, D0 is the present dividend that is 1. D1 is equal to D0 into 1 plus G, 1 into 1 plus 12% that is 1.12. By substituting this value K is equal to 1.12 divided by 20 plus 12%, 0.056 plus 12% that is 5.6% plus 12% is equal to 17.6% is the cost of equity. Having understood to find out the individual cost of capital of the components of capital structure, now we will move on to find out the weighted average cost of capital. Weighted average cost of capital is the overall cost of the firm. It depends on the capital structure of the firm. Weight means the proportion of the capital from a particular source to the total capital. To understand the concept and calculation of weighted average cost of capital, we will do a small problem which we have all studied in the school days. This is a very simple problem, but it will definitely make you understand the concept and the calculation of the weighted average cost of capital. One person purchased 6 apples at the rate of rupees 8 per apple and 4 oranges at the rate of rupees 6 per orange. What is the weighted average cost of the fruit? That is the question. One answer normally I am getting in the class is 7, that is 8 plus 6 divided by 2, that is the average. One way it is correct, it is an average of the apple and orange prices. but it is not the weighted average, because the weight of apple and orange is different. I mean, it is not the grams, but the number is different. So out of 10, apple is 6 and orange is 4. Definitely the proportion is different. When the proportion is different, we have to consider that also. We have just discussed that one. The proportion means the number of individual item divided by the total items. Weighted average cost of capital we can find out in three ways. The first thing is that we have to just multiply the number with the price and find out the what is the total amount paid and divide by the number of items purchased, so that we will get average price of one fruit. Since we divided by 10, all the items is represented in its proportion, because we divide by 10. Out of 10, apple is 6 and orange is 4. Second method, we will find out the proportion of each items. Now we can see that apple is 6 out of 10. The proportion is 6 by 10, and the orange is 4 out of 10. That is 4 by 10. So we will multiply the proportion with the price. 8 into 6 by 10, that is 4.8, and orange 6 into 4 by 10, that is 2.4. The total is 7.2. The same amount we got in the previous method. Next one is the percentage method. Percentage method is almost similar to the proportionate method. If we can easily convert to the percentage, we will do that. Otherwise, we will make it as a proportion. In the percentage method here, 6 by 10 into 100, you will get 60%. Apple is 60% and orange is 4 by 10 into 100, that is 40%. Now we will multiply the price with the percentage. 8 into 60%, 4.8. 6 into 40%, 2.4. The total is 7.2. Having gained a reasonable understanding of the weighted average cost of capital, now we will move on to a full-fledged problem. The particulars: book value and market value. Equity share at rupees 10 each. Book value 50 lakhs and market value 1 crore 5 lakh. Retained earnings 13 lakh and nil. 11% preference shares of rupees 100 each, 7 lakhs and 9 lakhs. 14% debenture of rupees 100 each, 30 lakhs and 36 lakhs. Market price of equity share is rupees 40 per share, and it is expected that a dividend of rupees 4 per share would be declared. The dividend per share is expected to grow at the rate of 8% every year. Income tax rate applicable to the company is 40%, and the shareholders' personal income tax rate is 20%. You are required to calculate 1. Cost of capital for each source of capital. 2. Weighted average cost of capital on the basis of the book value weights. And 3. Weighted average cost of capital on the basis of market value weights. First, we need to calculate the cost of capital of equity share, retained earnings, preference shares and debentures individually. Then we will find out the weighted average cost of capital on the basis of book value and market value. The formula for cost of equity is equal to D0 into 1 plus G divided by P0 plus G. D0 is given as 4, P0 is 40, G is 8%. Substituting these figures, we will get KE is equal to 4 into 1 plus 0.08 divided by 40 plus 8%. 4.32 divided by 40 plus 8%. 10.8% plus 8%, 18.8%. Cost of retained earnings. The profit can be retained by the company by not distributing it as dividend. The cost of retained earning is the opportunity cost of dividend foregone by the shareholders. When the cash is reinvested by the company, the opportunity cost is the expected rate of return that the shareholders could have obtained by investing in the company. So, the cost of retained earnings is nothing but the cost of equity. In general, the cost of retained earnings is equal to cost of equity, but if the flotation cost is there, the cost of equity will be higher than the cost of retained earnings, as the net proceeds is less in the case of equity. From the discussion, we can conclude that the cost of retained earnings or the expectation of the shareholders from the retained earnings is same as the cost of equity share capital, or 18.8%. But an additional information is given in the problem that the shareholders are subject to a personal income tax rate of 20%. So we need to reduce that 20%, just like in the case of a debenture, that is interest into 1 minus tax is taken as the cost. Here, the cost of reserve and surplus is equal to cost of equity into 1 minus tax rate, where Ks is the cost of retained earnings, K is the cost of equity, and TP is the personal tax. Substituting the values, cost of retained earnings is equal to 18.8 into 1 minus 20%, that is 15.04%. In the absence of the information like redemption value, discount or premium on issuing the preference share, the cost of preference share KP reduces to simple formula PD by P0. Since it is an 11% preference dividend, the preference dividend works out to be 11 and the face value is 100. And cost of preference dividend is equal to 11%. Now the cost of debenture. Since there is no information about the redeemability of the debenture, we will take it as an irredeemable debenture, and the formula is KD is equal to I into 1 minus T divided by NP, where I is the interest, T is the tax rate, and NP is the net proceeds. By substituting the values, we will get 14 into 1 minus 40% divided by 100 equals to 0.084 or 8.4%. Now we already found out the cost of different components of capital, that is equity share capital, preference share capital, debenture, and reserve and surplus. Now we need to find out the weighted average cost of capital. Weighted average cost of capital can be found out using book value method and market value method. First we will try the book value method. In order to find out the weighted average cost of capital as per the book value weights, we need to prepare a chart. We have written the components of capital in the first column: equity share, retained earnings, 11% preference share capital, and 14% debentures. The book value we have written against that one: 50, 13, 7, and 30 lakhs. These figures are all in lakhs. I have used some short forms in the chart because of the space constraint. Now we need to find out weight. It is easy to find out the weights because the total of the book value is 100. So equity share capital weight is 0.5 because 50 divided by 100, and retained earnings 13 divided by 100, that is 0.3, and so on. Now we have to tabulate the cost. We have already found out the cost and we have written the cost against each components of capital. Now need to multiply the cost and the weight. So we will get 9.4%, 1.96%, 0.77%, and 2.52%. The total will give you 14.65%. That is the weighted average cost of capital under the book value method. Now we need to find out the weighted average cost of capital using the market value weights. So the book value is replaced by the market value. The market value of equity share capital is given as 1 crore 5 lakhs, and 11% preference share capital is 9 lakhs, 14% debenture is 36 lakhs. So the weight will change, and the new weights are equity share 0.7, 11% preference share capital 0.06, and 14% debenture 0.24. And one thing you must note is that the total of the weight is always is 1. I forgot to mention it in the book value method. Of course, the cost of capital will remain the same, and we have to multiply the weight with the cost, and the product will be 13.16 in the case of equity share capital, and retained earnings is 0, 11% preference share capital 0.66, and 14% debenture, it is 2.02. The total or the weighted average cost of capital as per the market value is 15.84%. We have taken the market value of retained earnings as nil. It is true that retained earnings we cannot sell in the market and there is no market value. But the market value of equity share is influenced by the retained earnings. It is better to allocate the total market value between equity share and retained earnings in their book value ratio. By allocating the total market value of 1 crore 5 lakh in the ratio of 50 is to 13, that is the book value of equity share is to retained earnings, we will get the market value as 83.3 lakhs and 21.7 lakhs. So the weight will become 0.56 and 0.14 for equity and retained earnings respectively. Cost of retained earnings is 15.04% as we calculated earlier. By multiplying the weight and cost, we will get the products, and adding up, we will get 15.29%. It is a more logical approach solving the problem. D Limited is foreseeing a growth rate of 12% per annum in the next 2 years. The growth rate is likely to be 10% for the third year and fourth year. After that, the growth rate is expected to stabilize at 8% per annum. If the last dividend was Rs 1.5 per share and the investor's required rate of return is 16%, determine the current value of equity share of the company. The PV factors at 16% are year 1, 2, 3, 4, 0.862, 0.743, 0.641, and 0.552. Current value of the equity shares of D Limited is the sum of the following. 1. Present value of dividends payments during the year 1 to 4, and present value of expected market price at the end of the fourth year based on constant growth rate of 8%. Let us find out the present value of the dividends. The present dividend is given as 1.5 and the next year dividend is increased by 12%. So it is 1.5 into 1.12, that is 1.68. And the next year is again 12%, 1.68 into 1.12 is 1.88. And the third year 1.88 into only 10%, that is 2.07. And again in the fourth year it is 2.07 into 1.1, 2.28. And the present value factor at 16% is given as 0.862, 0.743 and 0.641, 0.552 respectively. So the total will come 1.45, 1.40, 1.33 and 1.26, and the total PV is 5.44. As per the dividend price approach, the market price of a share is the present value of its future dividends. We already found out the present value of the dividends for the first 4 years, 1 to 4. Now we need to find out the present value from the 5th year onwards to infinity. That is again the market price of the share at the end of the 4th year. Since it is an infinite series, we cannot work it out one by one, but we can use the formula for doing that one. The market price of share having perpetual dividend with growth rate 8% and expectation 16% can be found out by P0 is equal to D1 by KE minus G, where KE is the expectation and G is the growth rate and D1 is the next dividend. The expected market price at the end of the 4th year can be found out by D5 divided by KE minus G is equal to 2.28 into 1.08 divided by 16% minus 8%. 2.4624 divided by 8%, that is 30.78 rupees. Expected market price at the end of the 4th year is 30.78, and so we need to find out the present value of 30.78, and we already found out the present value of dividend from 1 to 4. So adding up these two, we will get the value of the equity share, that is 5.44 plus 16.99 is equal to 22.43. Next problem. While Limited retains rupees 7.5 lakhs out of its current earning, the expected rate of return to the shareholders if they have invested the funds elsewhere is 10%. The brokerage is 3% and the shareholders came in 30% tax bracket. Calculate the cost of retained earnings. This problem is a bit different from the problems we dealt so far. Here we need to find out the cost of retained earnings. And in the previous problem we discussed and found out that the cost of retained earnings is almost similar to the cost of equity. But here in this problem, to find out the equity, no information is given. So it is given that the expectation of the shareholders invested elsewhere is 10%. We need to evaluate from the point of view of the investor. He is getting 10% from the investment. Suppose that he is investing rupees 100. So his return is rupees 10. He is in 30% tax bracket. So he need to pay a tax of rupees 3 and the balance will be 7. So his return from the investment is rupees 7 only. He is investing an amount of rupees 100 and it is mentioned that a brokerage of 3%. In case of an investment, the 3% the investor has to pay to make his investment. So the total outgo is 103 rupees. Net income of the investor is rupees 7 and the net outflow or the net investment is rupees 103. So the percentage gain is 7 divided by 103, that is 6.796%. This is the expectation of the shareholder from the retained earnings also. So the cost of the company is same as 6.796%.